Thank you very much. Good afternoon, ladies and gentlemen. Kin is a slightly unusual story. You probably haven't heard a similar one today or yesterday. It's really a roller coaster story for the shareholders over the last 12 months or so. And I'll detail what the lead-ins were to that and the direction out of that for the next 18 months or so. Overview, and excuse me if I'm a little far away from the screen here, so I need my glasses to be able to read. Kin's located Leonora, a great endowed region, long history of gold mining obviously, and one of the features of the Leonora area is the depth potential of a number of ore bodies, multi-million ounce ones that are still being mined today, that have been mined for a long period of time. But Kin's contribution to that has been, to a large degree, only drilling the oxide and supergene zones of its deposits down to about 75 metres and commencing an operation, construction of an operation based on a feasibility study that didn't really address a large number of issues that are required to be addressed in a feasibility study. So construction was commenced amongst a whole raft of euphoria in the share price, and then the hard reality of operations and that very difficult jump from explorer to developer in the industry started to hit home. And so we suspended the construction in May this year, and we are undertaking the exploration and the development works that are required to deliver the project. Fundamentally, the assets are sound, but we do need to complete a whole raft of work to ensure that the execution of the construction and the execution of the development of the project is de-risked. The share price graph is probably the most salient point of this whole slide, but I'll point out a couple of other items. $4 million cash at the moment, and the shareholding is evenly distributed or dominated by retail and high net worth investors. And really the story is in the middle of the graph, as I mentioned. The suspension and the curtailment of the LGP was the catalyst for the re-rating of the stock by the market from about $65 to $70 per resource ounce down to $30 to $35 a resource ounce. So effectively the market has re-rated us at the suspension from a developer or a near-term producer back to a raw explorer. The LGP, as I mentioned, and it would be remiss of me not to highlight and explain the elements of the definitive feasibility study that was completed late last year. And I've highlighted in red there the elements that probably weren't done to the level that the feasibility study I am used to seeing. But it also highlights the opportunities that are associated with the project. In the top part under the mining heading, the grade's 1.5 grams, the stripping ratio is 8 to 1, and there were 10 pits, relatively small pits, all down to about 75 metres maximum depth associated with that feasibility study. And the vast majority of the ore in the ore reserve is in the oxide and transitional material. And simply in the two major deposits, the deposit hadn't been drilled deeper than about 75 metres. And there were a couple of assumptions in the feasibility study, water being one, where it was assumed that an open pit 25 kilometres to the north could be accessed for the water. Unfortunately, that proved to be that that water would only survive or only supply the plant for about 18 months before being depleted, and the open pits are quite dry when you drill them, and so there's not going to be a great deal of water coming from open pits, and so that was an issue associated with the water supply for the project, and we've had to do some work associated with shoring that up. And approvals, the plant site construction area was approved for clearing and construction, but all the mining area and all the pipeline work and all the roads and all the waste dumps and the tailings dam hadn't been approved. And so the assumption was that they would be approved during the course of the construct of the plant, and I'm much more used to having all those in place before you start spending the money on a plant construction. And the capital cost of $35.4 million for a 1.2 to 1.5 million tonne per annum plant is on the light side. So what's been done to date? Kin bought the second-hand Lawlers plant, 800,000 tonne per annum, from Goldfields, and it has constructed some of the new plant, and you see it on the screen there. $10 million has been spent, and some people might look at that and say, gee, you don't get very much for $10 million these days. But what's not shown there is the deconstruction that was done at Lawlers. Inside the large green shed there's about $5 million worth of equipment that is stored and catalogued and will be used in the construction. And fundamentally, what's been built there won't be wasted. That's a tank farm, and the shed and the workshop and shed and the office in the background. Now they'll all be utilised in the construction when it recommences at some point in time in the future. The operating strategy that was employed by Kin up until 4 or 5 months ago when I arrived was the owner build and fast track the development. We have reset that to a de-risk and enhance the project before we recommence the construction strategy. It'll be done conventionally. It won't be owner build. Owner build's not for the faint-hearted, and frankly, Kin within the group as it currently stands doesn't have the skill set to do an owner build on its own. And so we'll be delivering that with conventional EPC service providers who have been associated with the project up to date. We raised $11.3 million to do two things. We had a $5 million drawdown of a debt facility from Sprott, and that is being repaid. And the other funds associated with that capital raising, which we completed in June, are being used to advance the project along the lines that I've outlined. Work programs, we're working on ore supply, the water supply, as I've mentioned, tailings dam progress, and the approvals process, which will all need to come together before we refinance the project. At the end of the day, I believe that we'll get a much better quality project out of the assets here, and it will deliver it on a much more certain basis and with a much lower level of execution risk than was being contemplated in the previous DFS. One of the key features of the area, as I mentioned earlier, is that the majority of the ore bodies have only been drilled down to 50 to 75 metres through that oxide and transitional material, which is essentially supergene material sitting above a deeper primary source. The slide here illustrates the level of drilling that's been done at both the Lewis, Kite and Bruno on the left-hand side and the Rangoon Helens area on the right-hand side, which are both about 1 to 2 kilometres from the plant site. If you look at the panel that indicates the drilling below 100 metres, most of that drilling has been done in the last 6 months. So prior to 2018, there was virtually nothing below about 100 metres on these particular projects. And what that drilling has indicated is that, and I'm going to show you 3 examples of that: one at Helens, one at Bruno Lewis, and one at a project called Cardinia, called Mertondale, further to the north. At Helens, all the drill holes in the centre of the slide there have all been done in the last 4 or 5 months. The surface drilling, or the near surface drilling down to about 50 metres, was all part of the feasibility study, and that defined 2 relatively small open pits down to maximum 75 metres. And the drill results that we've had in that central zone indicate that the open pit will go significantly deeper than that once we finalise all the drilling there. Some of the intersections, 16 at 3, 14 at 3. Deepest hole there is at 250 metres, and that had 16 metres at nearly 4 grams in it, which was made up of 5 metres of 10 and 10 metres at 1.5. And that's in a lode that is parallel to this main lode. Lode never been discovered before, and one of the drill holes we pushed on and discovered a second parallel lode. So there's a a raft of additional drilling that have to be done at Helens to ensure that we get the maximum open pit and maximum cash flow out of this project. But so far so good. The drilling is indicating what I think the geologists suspected all along, that this primary source is actually a much better grade source than the near surface mineralisation. At Bruno Lewis, again, lots and lots of drilling. I think there's 3,000 drill holes in this particular deposit over about 3 kilometres. It's quite a large mineralised system, Bruno Lewis, excuse me. And again, in this last 6 or 7 months where we've drilled some deeper holes into it, it's quite high grade in that fresh zone. Some of the intersections there are 19 at 6 and 15 at 6 and 13 at 14 and a spectacular one of 16 at 37. Now most of those come out of the fresh rock material. So we've done a limited amount of deep drilling there in this last 6 months, and the next phase of work will shift its focus not only from Helens dominantly, but into this larger mineralised system at Bruno Lewis. So I think the message is that there's a lot more gold here than Kin appreciated, and extending into some of this deeper material is yielding particularly higher grade material in particular than what's been encountered in the near surface environment so far. Other opportunities, Munckton is a deposit about 25 kilometres north of the plant site. It was mined by Harbour Lights 30 years ago when the gold price was $450 an ounce. Open pit's down to about 80 or 90 metres. It stood up very well for the last 30 years, so no substantial geotechnical issues. You can see in the long section there the open pit. Grades at the base of the open pit, 16 at 5, 30 at 7, 12 at 10, drill holes outside the open pit, 9 at 9, 22 at 2.48. Kin hasn't drilled a single hole into this. This isn't even in the Leonora Gold Project mine plan. So it's a relatively simple thing to go and do a raft of work associated with this, drill out that dotted line envelope and convert a reasonable amount of this additional material into open pit mineable material. There's a potential metallurgical issue associated with this Munckton material. This particular deposit doesn't have a significant amount of the shale units, but that whole Munckton zone, and on the right hand side of that slide, the mineralisation's over about 5 or 6 kilometres reasonably continuously, and the Tonto and Eclipse material at depth does have some refractory and preg robbing elements associated with the black shale unit, but the material that we've seen and the mineralisation that we've seen so far at this Munckton 5 doesn't have that issue. I'll touch quickly on water supply because I get asked lots of questions about water supply. So previously the supply was going to come from pit dewatering and an open pit well north of the process plant. And we have done 4 production bores, 2 at Cardinia Creek, which is about 2 kilometres from the plant site, and at a location called Bummer Creek, we've drilled 2 production bores. And we've got very good water supply out of both of those. Bummer Creek's the better of them. It'll probably be the supplier of the long-term feed for the plant, but we have some more work to do, again, starting in November to ensure that occurs. I'll touch on the 2 main questions that I get asked: how long and how much is it going to cost? It's too early for me to give you a definitive answer on how much it's going to cost. My expectation is that the rate determining factor on this project, getting back into development, is going to be approvals, and they are 6 to 12 months away before I have a good understanding of exactly what that will be. We're working diligently on those things, but it's going to take more time and cost more money than everybody hoped for, but you'll end up with a significantly better project, in my view, than what Kin started on midway through last year. Thank you very much.